those sessions, volume was higher than that of the previous day, and 4 distribution days were missed because volumes were low on those days. So going forward as well, the count of distribution days and Nifty managing to stay above the key supports become really important. As we can see from the chart that Nifty is currently hovering around the 21 DMA and the distribution day count is standing at 2. So if going forward, the distribution day counts increase to more than 4 or maybe 6, then the market status may be changed to uptrend under pressure. If the market rebounds from these support levels, then the market will stay in a confirmed uptrend. So why people will ask why markets have been volatile. So let's talk about the macro setup in terms of global and the Indian front, why markets have been volatile. On the global macro front, too many data points have been released as US headline inflation that was released yesterday had touched 8.5% in March. The US Treasury curve initially got inverted, and then the US 10-year Treasury has been rallied for 7 straight sessions. Crude oil has been volatile around the 100-105 mark, as well as the Chinese lockdown, hawkish comments from the US Fed, as well as the ECB. If we talk about the Indian front as well, we had our RBI meeting on the last Friday itself, where interest rates were kept unchanged, and then CPI and IIP data was also released yesterday. So let's try and break down on these data points on what they are trying to tell us. In the past few days, US equities were tumbling and US treasuries were rising session on session, pricing in higher quantum of rate hike in the upcoming US Fed meeting in May. Earlier hawkish comments from Jerome Powell that during the year, a rate hike of more than 25 BPS may be required, and other US Fed officials also agreed on the need for a higher quantum of rate hike. If we look at the CME Fed Watch tool as well, which tracks the probability of the US Fed hiking or like reducing the interest rates, so even the Fed Watch tool is taking a rate hike of 50 probability of rate hike of 50 BPS by 87% at the moment. In the US Fed meeting minutes as well, they have decided to shrink the balance sheet by $95 billion a month, as the balance sheet has ballooned to nearly 7 trillion for the US Fed, which was less than half the size pre-pandemic. Plus, the recently released US CPI inflation data, which I discussed, has touched 8.5%, which was also higher than the consensus estimates of 8.4%. It's nearly at a 4-decade high at the moment. All the data points that I've talked at the moment are indicating to increase in the pace of tightening by the US Fed. Meanwhile, talking about the crude oil also has remained highly volatile in the last few days. It has corrected to below 100 per barrel on account of many trees in China going under lockdown, leading to demand pressure, as well as again covering back to $105 per barrel when Russia vowed to continue the war, saying that talks with Ukraine are at a dead end. On the domestic front, I mean, India's retail inflation also touched a 17-month high at 6.95% in March on account of rising food inflation. In the recently concluded RBI monetary policy meeting, the committee revised the growth estimates lower and the CPI inflation estimates higher. In this meeting for FY23, they have estimated crude oil prices to remain at $100 a barrel, where in the previous meeting they had taken the same estimate of around 75 to 80. So we can all see where the where the inflation is coming from. With the US inflation at 40-year high, even the UK inflation data that was released today is at a 30-year high, 7% for March at the moment. So India still looks better placed. But RBI held its status quo, but going forward, in order to control the inflation, maybe a few rate hikes would also be required by RBI as well. So these were the reasons that kept market highly volatile. And in order to tackle this volatility, William O'Neill has always said to make Nifty's chart or the market chart to be your best friend. Mayuresh, you wanted to add something?
Sure, Vakar. So can you put the Bank Nifty chart as well? So guys, am I audible in the first place
Yeah,
before
you're
I
audible.
start?
Yes, Mayuresh.
Sure. Yeah, so I'm just waiting for a few responses. Tanuj is saying yes. Maybe a few more at your end. So that can be a little bit of a super. Yeah, so what Vakar was mentioning in terms of uh, a lot of sideways movement that the market has been seeing, very choppy over the last few days, because the flow of information on the macro front is not allowing the market to have the breakouts that we probably saw a week back. And that is arguably justified because of the inflationary trends that have been witnessed across the globe. And this might very well continue, at least for the next few weeks, looking at how commodity price inflation is, looking at where crude is placed at $105. And therefore, the second round effects of inflation, along with higher commodity prices, are obviously going to create a huge amount of impact as far as the global markets are concerned. So Vakar touched upon a lot of points in terms of bond yields, inversion. I'm not touching base on that. But one aspect is that where the repo stands at this point of time, and where our own 10-year yield stands at around 7.2, 7.3, I think that is giving a sufficient amount of indication that there should be at least 4 rate hikes from the RBI to the tune of 25 bips each at least, which means at least a percentage rise over the next 9 months. Now, whether that happens, I think is highly debatable. Why? Because there is ample amount of liquidity into the system, and that's why I put up the Nifty Bank chart. Because you've seen that the Nifty has probably moved in one direction, but bank stocks have probably held on. Now, the divergence that has got created with Nifty Bank showing tremendous amount of resilience is actually protecting the downside risk for Nifty at this point of time. But coming back to the point in terms of whether those mandated 4 hikes, as the bond or the credit spreads are indicating, and even if you look at the corporate bond spreads, the AAA rated corporate bonds, the AA and the single A, the spreads between all these three are also indicating that better rated paper, obviously at any point of time, get better access to credit and liquidity compared to the lesser rated papers. But I think the spread there also is increasing in a fast magnitude, which probably means that lesser rated corporates might feel the hit when it comes to liquidity adjustments that might be probably needed. However, I was hearing the State Bank of India chairman on a business channel in the morning today, and he categorically mentioned that SME financing and MSME financing will continue because these players are the backbone and they are in absolute need, and we will provide them the growth impetus that is required. So, whether a percent rate hike happens, 4 rate hike happens, is debatable, as I said. But one issue in the entire aspect will be that liquidity still remains ample, and therefore a substantial rate hike to end borrowers might probably not be there. So Bank Nifty, as you see on the chart itself, has been very resilient. You have a look at these candles that have got posted, and that is probably giving huge amount of support for the market as a whole. If rate hikes come, do that have a huge impact for banks or banking stocks in general? Sentimentally, yes, but if you have a long drawn earnings trajectory drawn out for the banks itself, obviously they need to reassess their asset liability model. So, bucketing in terms of how their deposit investors are, uh, time deposit investors specifically, mapping them from a year, 2 year, 3 year, and then mapping it to the lending mechanism itself to protect their NIMs and spreads. I think that is what the banks are adept to doing. So if there is a nominal increase in terms of deposit rates on term deposits across tenor, you can very well expect that lending rates will go up by the same proportion, so that NIMs and spreads for banks will get protected. Banks which are having a better credit deposit ratio, banks which are having a better CASA ratio, Obviously, you hear about these technical terms, liability, franchise, so on and so forth. But banks having a larger CASA say will have access to these better placed low deposits, even if they go up on certain tenors, to mitigate the risk in terms of compression of NIMs, and thereby maintaining the spreads onto their individual balance sheets as well. On the other hand, one needs to be a little bit wary and careful in terms of the broader spectrum of NBFCs and other banking financial institutions. Why I'm saying that specifically? Because in a situation like this, I think abrupt lending also starts taking place, which then might probably mean that AUM growth might see a tremendous growth because of the aggressiveness shown vis-a-vis competition and vis-a-vis individual balance sheet dynamics to grow faster than the industry. But it might also be a capitulating factor in terms of asset quality pressures building up on their balance sheet. So a little bit vary in terms of the broader aspect in terms of these broader NBFCs, other banking financial institutions. So sticking to leaders, as we at O'Neill always put forth, is very critical. Now, how are the markets positioned at this point of time? Obviously, I think it's very choppy. We're very close to our moving averages, both when it comes to the Bank Nifty and the Nifty as well, and a lot of the other sectoral indices that we track as well. Two distribution days so far, but with the kind of macro news flow that is continuing and how earning season will play out, I think that is going to be one of the sole factors on how the market will react over the next 3 to 4 weeks. So earnings are going to be the crucial inflection point for the markets in terms of a breakout from the current levels or a breakdown and then consolidation at lower levels, whatever the case may be. Now, are earnings going to take a huge hit? Yes, they are, right? There are no two ways about it. If you would have heard Q3 commentaries, look at the commentaries that FMCG players have given, right? It's a clear indication on how the entire inflationary situation is getting played out. So I'll come to the commodity plays later, but FMCG companies actually track the mood and intensity of both rural, urban, and semi-urban areas as well. If you look at Q3 commentaries, a lot of players mentioned that they have to take price hike. Why? Because a lot of input prices have moved substantially northward, whether it's palm prices, whether it's sugar prices, wheat prices, milk prices, and the second round effects of freight and logistic costs also going higher. So if you look at you can put the Nifty FMCG also, Pakar, just in case. So if you probably look at the index itself, right, it's actually going nowhere. It had a nice up move in the first part of March till what we are seeing in April at this point of time as the line is getting drawn. But look at the volumes on this up move candles, right? The volumes have been far lower than the average volumes also for the index as a whole. Individual stocks, maybe a few stocks might be outliers. But when the selling comes, the volumes are much above average. So pressures, input pressures are definitely there. What these companies obviously resort to is lesser grammage, which basically means the price utna hi rakhenge, say for 100-gram pack of biscuits at say 12 rupees. But then the weight of that entire pack actually goes down. So instead of reducing prices, which can be detrimental, or increasing prices, which can be detrimental to volumes, they play on shrinkage or reducing grammage. Input costs are going to hit them hard. There is no two ways about it. You look at paint companies' commentaries. They've already taken substantial price hikes and more need to be taken. Look at commodity consumers, whether they are ferrous, non-ferrous, or crude derivatives, including certain specialty companies, including certain companies which are into the process of converting metals, which are into refractories, as an example. They're strongly dependent in terms of all these inputs as their raw material. And there are no alternate sources because supply chains are still very tight. China is under lockdown. Some parts of Southeast Asia are under lockdown. So the probable sources of supply are seeing supply pressures. You're seeing container pressures when it comes to shipping lines. And whatever freight lines are open, there are tremendous amount of rates that are being charged. So I was just having a look in terms of the Baltic indices, both dry and wet, and across route charters or channels that they operate out of. So from South China till the West Coast in the US, or from Hong Kong to the East Coast in the US, the rates have actually doubled or tripled, even on a year-on-year or a couple of years perspective. Or even if you take the other routes from the Suez to the European part or to the east coast of US have doubled as well. So you can assume and presume how much of an impact it is going to have along with supply issues. And therefore, I think getting out of these earnings hit, whether it takes a quarter or two, is going to be extremely tricky and challenging. And how the markets are going to navigate that, we'll come to know in the next 3 to 4 weeks. So I think to track distribution days, as I've said and mentioned, on three counts. One, on the main indices, say the Nifty and the Sensex. How is that count there? Then on the sub indices, on how the Nifty mid cap, the small cap is performing, and how the D-Day build up is happening. And then the individual sectors as well. We obviously are putting out on a weekly basis the D-Day count on all these aspects as well. And if there is some amount of structural pain, which the earnings will reflect on a domestic scene, and global earnings scene will also start in the next week or so, that can have a huge impact in terms of how even global markets will react. And why the bond markets and the bond yields are indicating what they are is probably what we'll be discussing maybe in the next couple of months as an hindsight. So we'll obviously need to put our eyes on this and affix this very, very clearly on all these macro fronts, how these macro funds are getting gestated and how they are getting reflected in terms of our D-Day count on all these three sub elements that we track. And the third part where earnings resilience might continue. So in case of things becoming very and earnings actually taking a hit, macro conditions locally and globally becoming worse off maybe over the next few weeks, in terms of inflationary concerns, so on, so forth, liquidity being withdrawn, and genuine concerns related to growth, you might again have the classical defensives in terms of pharma and IT doing well, because at least the cash flows remain extremely strong, though IT has come under tremendous amount of selling. And it is obvious because of the sheer outperformance. Mid-cap IT stocks have given 3x, 5x returns. Large caps have given almost 100 or 200% returns. And therefore, what you're probably seeing or expected to see is maybe resilience comes back for these sectors being classical defensives if the markets do have this amount of element coming through. The other element is there might be a sharp price correction into the markets, एक sudden fall आ जाता है, and then a time-wise correction and consolidation. And then which sectors probably come out? History suggests that, again, classical defensives come out to be the strongest because of their sheer ability to at least have earnings predictability and cash flows better than most other consuming or commodity producing stroke consuming sectors as well. So I think have a look at all these counts because this is going to be extremely critical. Our count, our mails, and our information is obviously disseminated to you. And therefore, this is how I will view the markets. It's a long weekend. So what I will do in the next couple of days is just see how these European and US markets are reacting to a lot of macro news. Before I sign off, I'll just take Santosh's question. I just answered Santosh on midcap IT. Tremendous outperformance out there. But you have to be very selective because the expectation now is that earnings are placed very strongly. If there is even a slight earnings miss or management commentaries being a little bit wary, that can be a little bit of a concerning factor. One headwind which is coming out for the sector as a whole is as travel and tours start again, as business offices get occupied again, the SG expenses might go higher. There is an element of a wage hike around the corner because attrition is crazy in the industry itself. Higher double teen attrition is not something that we thought will continue, but it is still continuing, which means that it is a kind of euphoria that is probably playing out. some ज़्यादा wage offer कर लिया किसी competitor ने तो उसमें निकल जाओ. So I think that is what is probably happening here, which probably means that there might be some element of margin compression along with the outside risk that if growth takes a hit, which the bond yields are indicating. We are not trying to presume or assume anything. If that probably happens, then client discretionary spending can probably take a hit as well. So we need to be very careful and also look at stages. A lot of stocks, if they're in late stages, stage 4, stage 5 as per O'Neill, they are extended. We normally avoid stage 4, stage 5 bases, and we obviously will expect them to cool off a tad bit. Coming out of a stage 2 will be an appropriate scenario, or even a stage 3, where the right side of the base is coming out of a long consolidation or creating a nice enough chart pattern that we'll see to enter. But pre-entering and entering beyond pivots is something that we'll clearly avoid. For gas distribution companies, input costs have gone through the roof. LNG prices are not cooling off at all. You've obviously seen the basket of Indian crude being increased to around $6.10 per MMBTU. which means that obviously these companies need to pass them through. And you've obviously seen price hikes happen. The latest has been a 5 rupee CNG hike per kg, and if I'm not mistaken, a 2 or 3 rupee SCM hike for PNG customers as well. So it's not an entire pass through as well, which basically means that the reported EBITDA per SCM, which means that the metric that these companies use is obviously going to be a little bit lower. Is there a volume hit that can be expected? There might be a volume hit because people can then look, at least in semi-urban and rural areas, in terms of consuming alternate fuels. So आप पे gas stove वापस आ सकते हैं, even in places which are having piped gas, because of the sheer dynamics of cost which are attached to that. And if that happens, then the operating leverage, which is a simple metric of volumes into price, take a hit, which is also applicable to FMCG companies to a large extent. So I think this is how I'll probably put it. To answer Raghunath's question, which sector for the short term, I think hotels, travel, leisure is something that can do well because they've incurred a huge amount of capex, Raghunath. So they are not directly involved in any inflationary pressures per se, right? Are consumers going to think twice? My own sense is that because of the lockdown pressures we had seen over the last 2 years, consumers are coming out thick and fast. You go on any portal. I tried that myself as a channel check on Ease My Trip, Yatra, and so many other channels, portals. It's very, very difficult if you spread out over the next 2 months in terms of finding good results, and the prices have gone through the roof. Are consumers willing to shell out extra prices, which airline companies might charge in terms of ATF prices moving higher for extra tickets? Yes. Are consumers trying to put extra money in terms of food and beverages, which might go out in terms of hotel tariffs? Yes. I think that's that revenge, pent up demand, revenge travel, whatever you call it. So travel tourism probably looks one reasonable aspect where earnings will probably hold out, and that's the best month or best quarter that they're probably looking at. The other is defensives, and within defensives itself, we've obviously added a few stocks both in terms of MSI and the swing trading portfolio as well. Both the teams is what we had detailed discussions on that. And therefore, I think they do get hit also with input costs. A few defensives also get hit because of semiconductor chips, some execution issues because of that. But still, I think on their order books, in terms of their execution capabilities, in terms of their receivable position and the dividend yields, the EPS ratings that they've got, the RS strength that they've got, I think they become attractive bets as well. Telecom, again, largely an inflationary hedge sector. Why? Because ARPU increases are a must, and they will keep on happening over a period of time. The recent spectrums, I think, we don't have sufficient time for that, but I think the recent spectrum cuts are not enough. So prima facie, the news was that the 36-40% cut is superb. It is not. A lot of people are expecting much more, and there is a lot more that is needed to be done, right? It's not as simple as that. The band that you're talking about in terms of 5G spectrum and the additional bands that you're probably talking, telecom operators expected much more, because apart from spectrum, there is a lot of other investments that go. Fiber backhaul, you need infrastructure developments, 5G enabled handsets, towers that need to be ready. But I think the overall sector should reasonably stand out as an inflationary hedge. People will keep on consuming data, and ARPUs will keep on going up. So I think these 2-3 sectors, in my opinion, can continue doing well, irrespective of inflationary hedge. And my opinion is that the earnings should, irrespective, hold out as well. For Ankit's question, is IT overvalued? Absolutely, it is. There is no two ways about it. But if the market reverses, so the point, Ankit, I'm trying to say is, if the market reverses, and we are not again presuming or assuming that, if there is a huge count on all these 3 parameters, Nifty, sub indices, and the sectors, and if there is a huge price correction that probably happens into the market, if any macro news goes waywards, IT pharma comes to the rescue, because at least they have some element of earnings visibility and earnings resilience, better than compared to most sectors that are at play. So with that, I think I'll hand it over to Vakar and Rajshekar as well. Tanuj, for your question, brilliant move on Adani Green, but as O'Neill puts it, if it's more than 110% move from the 200 DMA, it's a clear indication that you should exit, because there can be a sudden amount of supply if a stock exceeds 110% from its 200 DMA. And that itself becomes an interesting sign to watch out for. We watched out for that. We were having a reasonable amount of return, but Adani Green was 110% from its 200 DMA, and subscribing and adhering to our rules, we found it sensible to probably get out rather than waiting out and expecting that the stock might move higher from here. So I think sticking with rules and abiding by it is something that we will continue to do. So thanks for your time, guys. I'll be around, but Vakar and Raj will take a question.
Thank you, Mayuresh, for the inputs, and we'll wait a couple of minutes for the queries to get collated in, then we'll start off with the session.
Walker, I'll be taking the Axis Bank trading and share India
Okay.
Securities as well.
Sure, Ashutosh, sure.
As you can see, Axis Bank is currently trading in its up with handle base. Recently, it has broken out of its base pattern, but its RS is poor at 13. That is the reason we have not considered it as for addition. You can see after addition, the stock after breakout, the stock has moved over and is trading sideways. After breakout, we would ideally want the stock to gain momentum and trend upwards. Also, on volume front, there are volumes have been declining. Maybe some weekends are getting out of the stock. We might see some consolidation here, and depending on the breakout, we might consider the stock for addition later. Talking about other aspects for the stock, its EPS is very strong at 93. Its NPS are also have been improving on quarter-on-quarter basis, which is a very good sign. And also institutional investors have accumulated stocks recently in the last quarter as well, indicating strength in the company. But only concern is RS is a little poor at 39. We might see the company reports good results in the coming quarter. In the last quarter, we might see stock trending upwards and RS also improving accordingly.
Raj,
Yeah,
can you be a little louder? There's a comment for you to be a little louder.
yeah, sure. I also saw one query on share India Securities. Stock broke out from its stage 4 cup base pattern. Today itself, volume also higher, above average volume, indicating a strong breakout. Everything about the company is good. EPS of 99, indicating a good earnings profile. You can see here EPS has grown in triple digits, which is very strong. Also, the revenues have grown up in higher double digits, indicating good growth in the company. Price strength is also at 90, indicating good outperformance compared to overall universal of stocks. Buyer demand is also strong at A minus. The only concern is it's a stage 4 breakout. As pointed out in the introduction as well, we try to stay away from the late stage breakouts because these stocks are extended from the moving averages. You can see here from 200 EM it is extended around 65%. If there is any minor correction in the market due to any reason, these stocks will retrace back towards its moving average, so they will lose the most. Hence, we do not consider or try to avoid late stage breakouts. Wakar, can you take up few queries now?
Yeah, I'll take in a couple of queries, Rashikar. So someone asked what's the view on TCS results and what? Can you give me TCS chart, please? So as we all know, TCS announced its result a couple of days back, and if you can see, the stock is forming like a stage 2F base. So it's been really on a sideways movement for some time now, and inferring about the results, on the execution and on the performance front, the result was really good. If you look at the revenue growth, even in constant currency terms or in INR terms, the growth is really good. The company is able to grow. Plus, they is able in the Q4 as well, the company, I mean, the margin was slightly off high, the EBIT margin, but still around the 25% mark, the company was able to hold on to the margins. And the only concern was the attrition level. So the attrition level touched around 17.7% for the company in this quarter, comparing with around 15.5 or 15.6% for Q3 FY22. But the management is pretty confident in terms of their different verticals such as the BFSI, high tech, media, life science, retail, all to report double-digit growth in FY23. And even in FY22, the company, the CEO said that they ended the year with a good mid-teen double-digit growth. And going forward as well, they are expecting the growth to continue, and they don't see attrition as a major issue. And if you look at the order book or the TCV wins for the company, I mean, the Q4 was the highest, like around 11.4 billion, if I remember, was the TCV wins for the year, and then around 34.3 billion for FY22. So in terms of order wins and in terms of execution, it's clearly there. But as Mayuresh said, I mean, attrition in the IT sector is on another level now. And if you can look at the numbers as well for TCS, I mean, the biggest behemoth in your IT sector, it's around 17.7%. So around one fourth is the churn. So whether or not it will hit the margins, the EBIT margins going forward, I mean, slightly the EBIT margins have been off highs at the moment. So let's see around the Q1 and Q2 results how the EBIT margins get played out. Whether or not this attrition will have the effect, we'll get to know in the coming weeks, in the next year's results or the next quarter's results. The other query I saw was for Gokaldas exports. Okay. So again, really good stock. If you can see in terms of the rating, I mean, 98, 98 as the EPS strength. So if we track it on 100, so the top three stocks in terms of your EPS rating, your price strength is also superb at 88, along with your buyer demand. I mean, the shares held by funds are also increasing. I mean, the only thing that's problematic in terms from a technical front is like the stock has been falling lately, and you can see that in the RS line, and it's kind of trading very close to its 50 DMA. And even from a stage 3 base, the stock was not able to break out. I mean, if you can see on this 438.6 level, the stock tried to break out, but was unable to break out, and currently is like 13.8% off high. So I mean, on the fundamental front, the stock is really good. I mean, it's like one of India's largest apparel maker and exporter to over 50 countries, and has a superb in Q3 FY22 had a superb export revenue growth of 118%. Order book is really strong, booked for the next 2 quarters. All their capacities are running in at full capacities or full utilizations. If we talk about, they have applied for the PLI scheme as well, and plus set up a new subsidiary in Dubai, guided for margins to improve by 1 to 2% over the next 2 years. Like, but as we all know, your cotton prices have been on a really rising spree and have been rising month on month in 2022 as well. So that really adds to the pressure in terms of margin for these companies. So in the last con call as well, they said that the input prices for them have gone up by 50%. So this increase in cotton prices can really be a dampener for, I mean, the textile players going forward. I mean, the companies that are well integrated should be able to pass on the prices, but the people who take on the cotton and then process it going forward can have a little hit on the margin. So the Q4 FY22 results in terms of margins can be a little dampener, but the commentary would be a key for companies like these going forward. Raj, you want to take a couple
Yeah.
of queries?
Yeah, Vakar. Yeah, there are queries from Vasu regarding Gokaldas and Globus credits as well, and KPIT. Global spirits also the similar situation. Fundamentally, the stock is very good. It is indicating a EPS of 98. Every technical ratings as well are good. Price strength of 86 combined with the buyer demand of A rating. That is our buy watching stock. Similar situation here after good accumulation in the right side of the base around this area. The stock has not found a good momentum to break out and trend upwards. That's the reason we have stayed away from the stock. It has not broken out. Currently, it is forming a handle portion. We might see a breakout after this point. Then we can consider for addition. And on the negative front, the number of funds held by the institutions are decreasing the last quarter. That is a negative sign. Apart from this, everything about the company is doing good, both fundamentally and technically. Next, I'll move on to KPIT. KPIT also, it's our I watch the stock. We try to add it after a good rebound from its 100 DMA, but it had not happened. Currently, it reached its 100 DMA and is currently trading just around 1% below that level. This pink line is 100 DMA. If it retakes that level and goes above this particular level of 640, 630 level, we might consider for addition. Yes, is slightly poor because of previous quarters in December 20 and past to that. But the recent quarters, it has reported very good numbers on both sales and EPS. Hence, we might see an upgrade in the EPS rating. Technical ratings are doing good. Price strength of 80 and buyer demand of B plus are a good indication. Number of funds have also increased in the last quarter by 4%, indicating good demand for the stock among institutional investors. There have been lots of queries. I will filter them and will try to answer as many as possible. I'll move to Tata Power next. Okay, disclaimer here. As you can see here, it's a model portfolio stock. It is currently trading flat, just 0.4% from our ad price. It is continuing to trade in its ideal buy zone. The last two sessions, that is slight profit booking happened in the stock. A good sign is that volume have come down. That is a good sign. If you see on the accumulation days, the volumes have been very high. See the toppers here, indicating more higher demand for the stock than the selling pressure. Everything about the company was looking good. Hence, we have added. You can see here the during the base formation. The volumes you can see continue to be below average. This indicates weak hands getting out of the stock and see after this uptrend from stage 2C breakout of around 40%. These weak hands have gotten out of the stock during this consolidation phase. Again, the stock has given good breakout. That indicates that there are only faithful investors which have going to rally this further. That is the reason you can see the volumes have dried up. Taking a new fresh addition is advisable at this present moment because it is continuing to trade in its ideal buy zone. If it goes down below its pivot of 267, then you should not enter it. But now at this particular point, you can consider entering it, and if you are holding the stock, you can continue to hold it in your portfolio. There is IEX query as well from Prashant. Currently, the stock is not forming any base formation here, but you can see after 200 DMA breach in February, The stock has rebounded sharply, and currently it has retaken all its key moving averages except for 100 EMA. If that level is retaken as well, then you can take an alternative buy point according to O'Neill's methodology. Everything about the company, I can see the EPS is of 194, indicating good fundamental character for the stock. EPS and both the sales have been growing in higher double digits, indicating good growth in the company. Number of funds held by institutions have also increased by 14%. That is a very good indication of strength, and sponsorship has been increasing. That's a good sign for the company. And if you are holding the stock, you can continue to hold it and keep a tight stop loss of 5% from here. That is 50 DMA. If that level is breached, you can consider exiting the stock.
If you allow, I'll take a few queries.
Sure.
Yeah. So someone asked a query on ICL Indo count. Can you give me that? So I mean, the stock was really in a good rally in, the H1 FY22. If we look at that, and after that, the stock has been really tumbling. If you look at the price trend of 9, and even the EPS rating is not being, the company is not able to sustain the EPS growth as well, and the stock is like trading well below its key moving averages, and even the moving averages have started to trend downwards, or have shown negative momentum, and the stock has been like 43.62% off high. So initially, like in last year, why the stock was in momentum in terms of your the China plus one strategy, the ban on your Xinjiang cotton. So all those, this fundamental story was really good at the moment. The US being the key market, the prime market for them, because it contributes to around 75% of the revenue and plus 20% plus market share in bed sheet. So when people during the second lockdown, when people were staying in their homes, so the company is into home decor, your bed sheets, your quilts, your bed linen. So people wanted their homes to be as good as possible. So during the work from home phase, so at that moment the demand was really high. Then the supply chain or the logistic issue happened. So what Mayuresh was talking about earlier in terms of freight costs going going up by more than 2x or 3x in certain routes as well. So even the company was able, in the Q3 FY22 result, the company mentioned the same thing, that volumes are declined by around 12% to around 21.1 million meters on account of your supply chain challenges as well as your low demand in key geographies. So the same thing that I was talking about. So as the work from home would start easing off, and your supply chain issues being there, this pressure in terms of your demand pressure, along with the supply chain issue where the company is not able to export the volumes in the export markets. So US and Europe are the key export markets. So if they are not able to do that, or they're able to do it on a very high freight cost, that would dent their margins. So if they're taking some realization hikes or some price hikes, but still the company, the earnings were not able to sustain. And similarly can be seen in the EPS trend as well as in the stock price as well, the stock price being tumbling. The other query that I saw was for Newgen software. Again, if you look at the stock, the stock has been in a really long consolidation phase. It's like topped out around 765 some days, like some weeks back. After that, in July 5th, 2021, and post that, it's been really in a consolidation phase. The EPS strength is really good at around 92. Number of fund holding has been increasing, but as we all say, like, go for momentum stocks. So if you look at your price trend, the price trend with the rating as well as your line is not there. The rating is really poor at 18, and even the line is trending downwards, and even no good accumulation is happening. So the buyer demand is fair at sea as well. In terms of the results, if we talk about, strong growth was seen in the results in terms of their SaaS revenue posted a muted growth, but the other segments did had a good growth. Management commentary also hinted at a robust demand environment and healthy pipeline, but there's some finding there some delay in generating revenue from the GSI partnerships. So overall, like the fundamental story is still being good, and that can be seen in the EPS strength as well. But some of the stock is not able to translate that into the price trend. So let's wait for the stock to form some kind of base to trade above the key moving averages and have some kind of momentum shown in the price trend and the RS line. Then can be considered at that moment. Raj, the other query that I saw was for Balkrishna Industries, the tire company. Yeah, Industries. So again, like one of the unsuccessful breakouts, like if we look at from the cup base in September, post that, the stock is not able to find any kind of momentum. So looking at the price strength of poor is really bad, and even the RS rating has been going downwards. But the EPS strength of 91 is really good. So which is backed by a really good fundamental story. So if we talk about what Balkrishna Industry does, so it's a leader into the niche tire segment, using for heavy machinery or mining or agricultural purposes. And apart from other players, this Balkrishna is like leading, like the 80% of the revenue comes in from exports, and historically has been able to hold margins and upward of 20%, as well as the return ratios. But being one of the inputs being crude derivative, the margin pressure is obviously eminent with the company, and but the in terms of the growth prospects and everything, the ambition is there with the company to double their global market share to around 10% from 5 to 6% currently. And they're hoping that this robust demand will come from your agri and OTR to propel their volume growth. So in terms of volume pressure and everything, not volume pressure, in terms of margin pressure, let's see how the Q4 FY22 results get posted in by the company, and how the management commentary is still there, is still given by the company in terms of positive demand outlook, or in terms of even the freight costs and everything. The logistic issue faced by the company.
Okay, I'll take this now.
Yeah. Okay.
Mohammed has a question on what does EPS strength indicates. For the benefit of everyone, EPS strength is a fundamental rating for the company. It's a earning per share strength. EPS stands for earning per share. As you can see, if a company is reporting good numbers on quarter-on-quarter basis, and the numbers have been accelerating, if we are comparing on year-on-year basis, then that company will have a higher EPS strength. So all the companies will be scaled on 0 to 100 level, on a scale of 0 to 100, and whichever company has reported good acceleration in their EPS growth, that number will be ranked higher. Hence, stocks which have higher rating, like around 80 to 100, those stocks are predominantly called as fundamentally strong companies. You can see here Balkrishna has a good EPS of 91. Hence, we have categorized it as a great in terms of EPS strength. However, on price strength, it is a poor rating, because price strength is a technical character of the company. As the stock has failed breakout and it has breached its key moving averages, whereas the overall market is trending above key moving averages, this stock is trading below key moving averages. That indicates underperformance when compared to general market. Hence, its RS is poor. Okay, I'll take a few stock queries now. I have seen Kitex stock query a couple of times. Again, a very good fundamental company with a very good technical profile as well. EPS of 82 and price strength of 80. Stock has broken out yesterday from its stage 3 consolidation phase on above average volume. You can see the good accumulation happened here at this particular point. Also on the down days, that is on the peak days, candle days, I can see the volumes have been below average. That indicates weak hands have been getting cut and only strong hands are staying in the stock. It is a good indication. Other aspects about the company, like number of funds have increased, even though it is just a 25, but being a 2000 crore market cap company, that is a very good number, and it has increased around 150% on quarter basis. Also, the shares held by the institutions have also increased about 100%, more than doubled, indicating good sponsorship for this stock among institutions. But today's action is not so good. If you see here, after breaking out and making a high of 309, the stock has closed in the lowest part of the day's range. You'll see here, low is 295 and the stock closed at 296, indicating a weak closing for the stock. It might be a top formation as well. I'm not pretty sure at this particular point, but depending on tomorrow's action, we can say what is the uh, uh, next trajectory for the stock. Prior to that, you can see back to back 8% gain. So some kind of profit booking can be expected in the coming sessions starting from Monday, because people who have gained around 16-70% in just 2 sessions, they might be exiting the stock. So we might see some consolidation at this junction for the stock. I'll take a Tinplate as well. As previously pointed out as well, most of the stocks are breaking about out of their late stage basis. Here you can see it's a stage 4 breakout in this case as well. Everything about the company, EPS, RS, everything is looking good on ratings wise. Only only one thing that is lagging, weighing down, is that late stage breakout. It's a stage 4, hence we will not. If there is any new factor or in factor on the company's front, then we might consider for addition. But this for a late stage phase, because the risk reward is slightly skewed towards higher risk, because it's very much extended from the key moving averages. Like you can see here, 50 DMA is around 15% from this CMP, and it might retrace towards its 50 DMA. Manoj, the stages and the breakout can be seen on the MarketSmith chart. You can see our algorithm identifies the stage count and base formation as well. Okay, can you take a few queries, and we'll I think we'll take a couple of queries and we'll close the session. It's near to about 5:30. You can always write to us on email. We'll answer them more in depth. We'll take time to answer your queries.
Oh, that's okay. So I mean, I'll take in a few queries. So Mr. Prem Kumar was asking, like, how do we classify like Tinplate as a stage 4 breakout? Let's explain that, Mr. Raj. Uh, so as you can all see, like from the on this chart, I mean, the stock is formed like the count is 4 and the pattern is consolidation. So how do the counts change in terms of numeric and in terms of alphabetical order? So if the numeric, if the stock rises by more than 20 to 25%, then and then consolidates, then the change in your and the count will happen on a numeric front. So like if the stock is forming a stage one base, it advances from post the breakout, it advances like more than 20, 25, 30%, and then consolidates, it becomes a stage two base. But if, and similarly going forward like that, the count will increase. But if that kind of a movement of more than 20, 25% doesn't happen, and the stock like is consolidating on a sideways trend, then the count will happen like 2A, 2B, 2C, 2D kind of a thing. So that's how. So this stock has advanced like after every base would have advanced more than 20 to 25%. That's why the count has increased in a numerical fashion. So I hope I was clear on my explanation. So recently I can see a query on Tata Elxsi. Can you give me Tata Elxsi, please? So guys, we are running out of time. So I'll try to take in a few queries as fast as possible in terms of the chart and the technical front. If I start explaining on the fundamentals, that might take time. So let me just rush in with a few queries on the technical front. So talking about Elxsi, like again, one of the favorite stocks in the stock in terms of the query section of Stock Durbar. But yes, if you can look at the stock in the count, it's forming a stage 4B base. So again, what Raj and Mayuresh explained in terms of late stage bases, 4, 5, 6, and higher. So these stage bases are prone to get failed. It's not completely failed at the moment because like from a 4A base, it tried to break out, then it moved below its key moving averages, is trying to break out again. But yes, very few, very handful of stocks are able to form higher bases. And in general, the rule that stages with 4 and above are considered high stage bases, which are prone to failure. But looking at the EPS strength and of 93 as well as the fund holding, the fundamental story remains really good. But let's wait. I mean, whoever wants to take in a new position, let's wait for the stage count to get reset before in order to take any kind of position in the stock. And the other query we'll go for is like fine organics. Okay, there is no stage formation. Yeah, so no stage formation for the stock. I guess I'm not being able to see any kind of stage formation. But if you look at the fund holdings, the number of funds as well as the share held by funds has been increasing on a quarter-on-quarter basis. I mean, the fundamental profile for the company is really superb in terms of the EPS strength of 98, which can be translated, which can be seen translating in the RS line as well. I mean, the RS line is in the last few days has been trending higher. The stock has a good buyer demand, but yes, I mean, cannot see any stage here. I mean, the pattern here. So let the stock form a pattern and breakout, give a clean breakout from that pattern. Then can be a good fundamental stock to be considered.
Rajiv has a query on LTA and LTTS. It's not like that we ignored the stocks deliberately. It's mostly because of we get lots of queries. In between, we might miss some of the queries.
Yeah, Raj, you can take final queries as LTI and Mindtree, and then give your closing remarks and end the session.
Sure. Yeah.
Thank you.
In case of LTI, you can see it's a stage 4 breakout. We have been talking about late stage basis. In the end, we have found a perfect example of why late stage basis fail. You can see here after stage 3 breakout in July, the stock has given tremendous returns from around 4,000 levels. It has gone up to 7,500 levels, almost double in just 3 months of time. After which it has formed a stage 4 base cup base pattern. However, you can see here after the breakout, it has completely failed and it has reached all its key moving averages. First, starting with short-term moving average like 21, 50, 100. It has found support at 200 DMA. Being a fundamentally strong company, you can expect a support at its long-term moving average like 200 DMA. However, you can see yesterday it has closed below that level. Today it has taken that level on good, not so good volume, just average volume. But you can see why we tend to not add stocks breaking out of late stage basis. I can see easily our stop loss of 7 to 8% will get hit in within just 2 to 3 sessions. So it is risk is always skewed here in this late stage basis. But talking about the fundamental character of the stock, it is very good company. We all know it. It has a number of funds have also increased. Being a 1 lakh market cap company, still the new funds have been taking positions in the company. It's a good sign. You can see EPS and sales front company has been growing in double digits. Hence, its EPS is of 89. Because of its underperformance compared to the general market, its RS line has declined and its rating is at 43, belonging to the poor category. Yeah, fundamental character of the company stays intact, but only technicals have deteriorated in the last 2 to 3 months. I'll take LDTS and we'll close the session. We already 3 minutes past the deadline. Again, I can see here the LTTS has broken out from stage 3 in January, but after breaking that from that base, the stock has failed and it reached its 50, 100 DMS at this particular point. Similar story compared to LTA as well, belonging to the same group of companies, found support at the 200 DMA. You can see here the stage count has been reset to 1 because it has undercut the previous stage low. That is why the stage count has been reset to 1. Reached its 200 DMA recently, today, and fundamental character is strong at 89, but only that stock has underperformed compared to general market, and its ratings have deteriorated. Technical ratings to be like RS has deteriorated to 51 and buyer demand at D, indicating not so good demand for the stock among buyers. So initiating a fresh positions is not advisable at this particular point. If the stock breaks out from this particular base pattern, we might consider for addition. By the time RS line will also trend higher and RS rating will improve by that time. I think we have answered most of the stock queries, and also we try to explain our methodology by explaining the stock queries. Please write to us on email any stock specific query or any product related query or any methodology related query if you have. We'll take time and we'll explain in depth our methodology. And thanks everyone for joining Stock Durbar. We'll be again hosting the session. It's a bi-weekly session. So please join the next session as well. Thanks and